Out on the construction job, what I do a lot of times when I'm driving back and forth is I take and look at the different areas I'm in. I'm looking at houses that, the signs go up in the front yard for sale. I look at houses that are being built. A lot of times I'll get out and walk at different construction sites and just basically see who's working, what stage they're in, if it's an owner build, if it's a company building it. If I've noticed over the last year or so, there's been fewer and fewer and fewer of these happening. When I pulled up Zero Hedge, I was looking, and one of the articles that I just found was that it said that nearly half of the $700 billion in homes listed for sale across the country have gone stale. Stale would be anything that's been on the market for at least, probably in this market, 45 to 60 days. So if you look at if there's $1.4 trillion of homes that are listed on the market and 700 billion of that has gone stale, that's a pretty big number. That's trying to tell us something. Um, the other number metric that I saw that was really high was that the number of buyers outpaced, or there was 500,000 more buyers than there was actually sellers. So that's a pretty big metric as well. Look at see what's happening in areas like Florida, Arizona, Nevada, and Texas. I mean, they're kind of getting a little bit hit harder than anybody else in all of this. They've had such a boom that it's tend to go in a different direction. So the stale inventory is basically code in the real estate industry for the homes that have been on the market longer than they say 30 to 60 days without meaningful offers. Um, in a healthy market, homes are sell a little bit quickly, often within 15 to 30 days. In a hot market, sometimes a weekend. We were in a very, very hot market. A lot of times when houses came on the market, they sold right away. Now it seems like houses, it takes them a little bit more time, unless it's something that's really desirable, something somebody's been looking for. But it's a big difference. Redfin has reports that over 49% of homes on the market today are listed longer than 45 days. So that's nearly half of all houses are listed longer than 45 days, which is a huge difference than what it had been uh, just 3, 4, 5, 6 months ago. I'd really say the market really kind of shifted like September, October is when I really saw it. We had, and when I say we, I work as an independent project manager on different construction projects. So the pipeline of work that was coming over the last 3 years was ginormous. I mean, people had to wait. That started projects started falling off, started going to redesign, because when you do a project, a lot of times what happens is that what happens all the time is that an architect or civil engineer get involved. The owner of the project, whoever's pushing it forward, wants estimates on what things are going to cost. They look at it, determine that that's too much. They want to spend, or they want to go in a different direction, or whatever the reasons being. It usually goes back into a redesign phase, uh, and it's always people trying to get more for less. I mean, it's just I don't think I've ever seen it not go that way. And usually, what happens is the problem with that is when people want more for less, is that there's an expectation level of what they want. And at times, that isn't uh, really conducive for the relationship going forward, because someone's going to be disappointed. And I always say that it's always about managing expectations. And if someone is trying to get something accomplished or get something built, and they have it in their mind, it's going to cost X, and everybody in the project knows it's going to cost Y, I always open my big mouth and say, listen, this are you comfortable with this? This is where we're headed. And oftentimes I am told that they got it, they understand it. I'd say 65 to 70% of the time, you get three quarters or more the way through a project like that, and the owner comes back to him and says, I can't, I can't stomach this anymore. We're way over budget. I'm going, whoa, we're not way over budget. We've been, every week you get a report, and also, and again, it goes back to managing that expectation of what um, that person was expecting, or what they thought they were going to get in their own mind. And there's a reality part of it, is that those it doesn't always translate, or it feels as transparent to them, because a lot of times people have rose colored glasses on. I've always been called realistic Rick. I always tell people I have a 2x4 in my back pocket, and I have to get out sometimes and swing and hit people across the head to make them wake up, things like that. Now, I've often had people that we've done projects for and are ecstatic because it comes in near or close. You can always, when you do a project, when you're building something, or any type thing, it, if you can manage that expectation, be realistic, and look at it as you're going and as the changes develop, because there's going to be changes. I always tell people that when we design a house or a building or anything like that, that I can guarantee one thing. I can typically guarantee that whatever's driven or designed or starts is almost 100% with certainty not going to be what you end up with, unless you're just you're not uh, you don't have anybody involved in the project, that you're just simply building it to sell. If you're a track builder, yes, you can probably get by with building whatever the project is exactly to the specs in which you designed it, and looking for someone to either rent it or sell it. If you're involved with the owner as they go forward, they're always making changes. You do an electrical walkthrough, they're moving outlets, they're changing lights, they're changing different things. They walk up on the project, they don't like where the sidewalk is, they want to change the driveway, they want to change entryways, they want to change the out, the exterior facade of it. There's always changes, and there's so many. It happens almost every project. People will see new materials, or they see something down the road, or they see something that they like, and they want to make those changes. Every time there's a change, there's a cost associated with making that change. Very rarely, very rarely is that change less expensive. Now, if you're substituting a less expensive material or something in that nature, or something that is cutting down on man hours, yes, there are ways to, we call, value engineer or cut costs by doing that. The only problem with that is that again, there's that expectation that people are going to want, that when it is complete, that it met that expectation. Even you've talked it to death, you've actually gone through and explained everything of what is going to be different about it, whether it's pictures, you take them out to different finished projects, whatever it might be. Again, it's that expectation level. So this is where the real estate market is going. The expectation level of the seller is that houses are uh, not going down in value. They've been basically for the last couple years have been told, there's a bidding war. They see all this. So that expectation of that seller is one in which they want to get top dollar. They don't want to do anything to to their property to sell it. They just think people are going to be in line. Was that the case? Yes. Do markets change all the time? Absolutely. Are we seeing that right now? Yes. Is there a breakdown happening? Absolutely. And that breakdown is the expectation now of the buyer, because the buyer is going through a situation where interest rates have changed. They're no longer 3.5, 4%. They're north of 7, 7.25, 7.5%. Uh, there is not much inventory on the market for how many buyers that are out there. So, but there's an affordability issue, because if you're in a point where you're trying to buy a house and you are a buyer and your expectation level and your budget is one thing, a lot of times real estate agents, or even the person himself that is actually buying it, will push themselves to the brink, push themselves to the limit on affordability. Um, That has worked out over the last 5 years in the fact that people pushed themselves to uh, that limit of what affordability was, and they had an appreciation housing market that kind of bailed them out along the way. Wages have not kept up with inflation or anything else, so you kind of got bailed out on your valuations because of the appreciation in the housing market. Now we're starting, definitely have seen a leveling off. I think we've peaked and actually are starting to go down on the other side. So now what's happening is the fact that sellers, for the most part, have that have been in their homes for a while, they have low mortgage costs. The money in which they borrowed is low. They've either paid it off or they don't need to make a change. So that is really constricted the number of homes on the market. So the expectation of a seller hasn't changed, in which they still feel that their houses are worth so much more than they actually are. The buyers, on the other stand, are adjusting because everything else around them has hit them hard with just the cost of living and the cost of money to buy that home. So they're looking for something less expensive because their affordability has not increased to the point to match what that seller is. So again, there's the supply and the demand dynamic. You know, when you go to look at prices, if you understand supply and the demand, that that's what sets your market in any market, really. So, what this is telling us, there's a red flag out there. It tells us buyers are backing out, pricing is disconnected from reality, the affordability ceiling has been hit, or we're at the top, and sellers are still clinging to 2021 price streams. Um, the result the result is going to be price cuts if you want to sell it, stagnant listings, and eventually there's going to be some desperation. Last night I was looking on Facebook Marketplace, and one of the things I always like to look at is I look at um, what is available on the market as far as cars, all different things, tools. I mean, I work with my hands a lot, so I'm always looking for tools, things that I don't have that I want to add to it. Mostly it's woodworking, sometimes metalworking stuff that I'm looking for. Um, looking for, always looking at ATVs, UTVs, old pickup trucks, different things, not boats. Not that I'm buying it, I just like to look at that stuff. So, let's take a step back and explore that 500,000 plus more sellers surplus. Um, mortgage rate paralysis. The 30-year fixed rates are hovering between 7 and 7 are punishing, the buyers. Example, on a $500,000 house with a 7.25% interest, you're looking at over $1,400 a month in principal and interest alone. $3,400. I'm sorry, I can't even see. $3,400 a month in principal and interest. You add the taxes, insurance, and you're well over $4,000 a month. So that locks out a huge portion of what we call middle class people. Um, there's a golden handcuff of those low rates that are handcuffing people into their homes. It says roughly 80% of current mortgage holders have rates below 40%. Why would they give up a $1,500 mortgage to take on a $3,200 mortgage? Doesn't make sense um, at all, uh, unless they can buy down the mortgage uh, in the sense where if they were to sell a house, they take that equity and they're financing less, but still the cost of money is still high compared to what they're used to. If they want to sell but don't need to sell, so they list it high and wait. So that's where the disconnect is. If you have to sell, you're going to drop your prices. If you don't have to sell, you're going to hold steady. So, a negotiation is always communication. Uh, it's asking questions. It's finding the motives. It's finding what somebody wants. It's finding to get to a common ground. It's a when you negotiate. There's a lot of tricks or skills that you can learn in negotiation that will help you. And there's a lot of things that can hurt you in negotiation. Uh, I've always been told I'm a very good negotiator for other people because I know exactly what the person or client that I'm representing, I know what they want, and I'm less willing to bend or give than they are. So I'm very good at that. My own self, I'm not necessarily as good as negotiator for myself because I'm in a different uh, perspective. I'm in a different position than when I'm doing it for somebody else. Um, so, anyways, you always got to know yourself when you're negotiating. Um, Many sellers are still emotional. They're again anchored to that 21. Again, that's an expectation level that was set. Uh, they think in their mind, I saw a house on my block sell for 850. Why should I less, why should I list it for 740? In almost every case, not all the time, but the majority of the time, when someone sees a house go up on the market and they see it go for 850, they think my house is better because it's their house. It's just a perspective and an emotion that they have. Now, it's not always the case. It could be the floor plan of the house. It could be the acreage. It could be the color. There's a lot of different reasons why it could not be this, the same price. But that's not again the expectation or the perspective that the seller has. Um, but that 850,000 buyer, when they had a 3% rate and now it's 7.5%, that is a dramatic difference in what it's going to cost that buyer. So, talk about ground zero for stale housing. States that boomed during COVID are now freezing up hard. Now, these areas are typically like Florida. Florida saw a mass influx of people during COVID. DeSantis and the Florida government was much different than other states. So you had a lot of people. A lot of people were working remotely. So they picked up and moved. Um, Florida's gotten probably I'd say a triple whammy at least. Um, they have experienced natural disasters with hurricanes. Their west coast has gotten pounded um, with storms, which I've lived in Florida. So you don't necessarily have to be on the coast. Now, a lot of the dramatic damage that's happened is where that storm surge has come through. But you can be in the middle of Florida or even on the East Coast and a hurricane come up. Those tornadoes that come through, you could just be at the wrong place at the wrong time and tornadoes hit. Uh, Florida takes water well because it's a lot of sand. So it can rain in Florida and rain 6 inches, and within an hour, it's gone. If you're in the Northeast and it rains 6 inches, that's a big deal. The water's clay, soils are different. It doesn't perk, it doesn't go through it like it does in a place like Florida. Um, the houses are built different in Florida than in other areas. So, but they've gotten devastated by natural disasters. Along with that has come the fact that they've gotten hit with the uh, insurance companies that have gotten whacked. So a lot of insurance companies do not want anything to do with Florida to for homeowners insurance because of the losses in which a lot of these insurance companies have have had. So the a lot of the insurance companies that are still left in Florida have raised rates. So there's something in Florida called going naked, which basically means that you own a property and you are not insured. You don't have homeowners insurance on it. And I saw one statistic that said up to 45% of the people in Florida are going what they call naked. So um, that is something that has hit a lot of people because forget about the mortgage, the principal and interest on the mortgage itself, but you have a dynamic of the insurance cost on that home, or maybe it's flood insurance, whatever that insurance cost is, that is significantly gone up. The other thing that's going up is you've had this influx of people into Florida in the infrastructure in itself. You have the local municipalities that have changed zoning laws, how they view when they reappraise a property and how they reappraise it. So there's been cases where people have taken older houses in Florida and they've done more than a 50% um, increase in square footage, or they've made it a two-story home, a lot of different things that they have done. That triggers in a lot of counties in Florida a complete reevaluation or a reappraisal of that property. That has happened where people have gone down and done those things to where they may have had a $4,000 um, tax bill, local tax, real estate bill, and they've redone the property. And I've heard stories where it has gone 600% higher than what it is. They may have a 25. I mean, the worst case that I heard was where someone was paying around $10,000 a year, and they redid a home that basically was inherited, and that new appraisal. It was on a canal. It was outside of Miami. Um, and this was a real world situation where that property tax came due was, I think, $92,000. I mean, it went from like 10 to 92. I mean, that is dramatic. So uh, that is something to definitely watch, are these tax liens that are going to pop up in Florida. So again, you've had natural disasters, you've had insurance. The other thing that's happened is with the disaster that happened with condo units, any neighborhood that has a homeowners association, Florida initiated a thing where you have to go through your bylaws, and you have to do a appraise or assessments, in the sense where you have to look at whether you have a building, whether it's a condo, townhouse, or whatever, where they have to go through and uh, do like a maintenance thing where they look at the building, they have it evaluated, they come up with a plan. So you've had HOAs, um, homeowners uh, fees, going up dramatically. I'll take an example of someone that I know that's in the Cocoa Beach area, where when they first moved into their condo unit, they retired. They had a condo on the beach in Cocoa Beach. When they first moved there, their HOA fees were $350 a month. He got involved with the homeowners association, ended up becoming president. The disaster happened down in Miami where the building fell down. Florida enacted this new legislation. They had to go through, do a complete assessment of this property in Cocoa Beach. They had to do all these repairs, get it inspected. That in itself, uh, their homeowner fees went from $350 a month to $1,300 a month. So a lot of these areas are getting literally whacked with these HOA fees. Now you have a situation where, again, you had interest rates down at that 2.5 to 4% range. That has made affordability different, because now you're looking at a 7.25, 7.5% interest rate fee. So that has also hit. So the pure cost of building has increased. Um, just the labor itself has increased. Forget about the raw materials going into it. I had a conversation this morning with one of my clients, and we were talking about tariffs, and we're talking about China. And I I have a very large client that I consult with, and it's working with steel as a commodity, and the products that I consult on are all basically based in steel. One of the competitors of my client, everything they get, it comes from China. And the discussion went like this: what do we think is going to happen with the Trump tariffs? Now, on this one particular case, it was great because we were able to get a very large client because of the tariffs that Trump imposed, the 140%, raising it by, settling in, giving this pause and everything. Well, it spooked this big client to where it's about a $40 million deal in the first 6 months, because just because the country of origin of this product is different than China. Actually, it's coming from Taiwan and Vietnam, even though it's hit with a higher tariff than it was before, but it's not compared to China. So this company kind of freaked out. They've made this change. Well, you can't advise on where you think that's going, because that's a geopolitical pressure that happened. So the geopolitical pressures that are happening, they influence everything in the commodity of what is going into building that house. So everything from HVAC units, the compressor that sits outside for your system, whether it's a mini split system or a heat pump, the sheet metal that makes your duct work, most plastics and stuff like that. Now that is associated a lot of times with petroleum. That has gone down to some degree. Um, Wood has gone down to some degree, uh, but your your lighting fixtures, almost all that comes from China. Fuses, all those types of things, breakers. There's just so much of that stuff that comes from China. The other thing that's happened that nobody's talking about is the um, thing with the update of code. So whenever you're building something, the local municipality, which issues your permit, will go by, we call them IBCs, International Building Codes. So what happens is there's a group or task force that gets together. They recommend changes. So some of the biggest changes that have happened on these international building codes is increase the cost of building. Uh, so, for example, uh, GFI breakers. Um, if you were to have built something by 2017 code on GFI breakers, you probably would only have to have GFI circuits, ground fault indicated circuits, within wet areas, whether it's bathrooms, kitchens, things like that. If you're up on some of the more updated versions of the IBC, one of the counties I deal with, now the whole house has to be on GFI, and they have to have the whole house is on GFI breakers. So just the cost in breakers alone, and just how in which we wire the houses because of the code, is dramatic. For example, look at an island in a kitchen. Before, you would have electrical outlets that were around the island in the kitchen. Uh, a lot of the new IBC codes, you can't have outlets unless they're pop-up outlets on top of the counter. The difference between a pop-up outlet and an outlet that is a typical outlet that you would have on a wall on the side of an island, that it's, oh my gosh, it's such a huge difference in price. Um, and not only that, the labor. When you start putting outlets in countertops, if you're using even linoleum or something like that, the time to cut it out, put the box in, um, uh, if you're using granite, stone, any of the other silestone, any of the other materials on your countertops, just to cut those in is greater. The trim out is greater. Everything about it is greater. So you could say that if you built the same house before your code went up, you could see sometimes a $30,000 difference in just building because of the code in which was enforced at the time the house was built or building was built. Insulation is a huge thing that is changing. Years ago, back in the 70s, most houses were built with 2x4s. Some houses didn't even use plywood sheathing on them. Now, most houses are built on 2x6s because of the code for insulation. Well, now those codes are going even higher in what they are um, uh, requiring. So it could be in the roof. Now you need an R49 in your roof, or you need an R41 in your walls. So that typically, when you go to something like that on those building codes, it could mean that instead of putting bat or fiberglass insulation in that house, you're now using foam. And it could be you're not using open cell foam, but you're using closed cell foam or a combination of closed cell and open cell. Now, what all that means is that if you use spray foam in a house, it costs a lot more money to do that than if you use just traditional bat roll insulation, fiberglass insulation. There's, there's a big difference in cost of what that is. So uh, there's all these different things that are causing houses to go up in price. So let's look at the median home in Tampa. If it's 425,000, the that monthly cost to own exceeds $3,000 a month. So again, Florida's getting whacked. Phoenix, Arizona, it exploded between 20 and 2022. Massive investor and institutional buying. But now Zillow reports homes listed over 60 days rose by 70% in Maricopa County in 2025 alone. One home listed at 49 in February is now down to 419 after 90 days. So that is a $70,000 decline in price. So you're that's pretty that's a pretty good price reduction. Um, Vegas, it's known for its boom and bust history. Today the number median time on the market is 54 days. A lot of builders are offering up to 50K in incentives. A lot of buyer fatigue in that Vegas market. Texas, you're seeing Austin, Dallas, San Antonio. Austin leads the country in price cuts and inventory growth. Now, Austin led the again, it led this boom phase. Austin exploded. A lot of companies moved out of California, went to Austin, and they had this huge boom. Now they're seeing a little bit of that bust cycle or correction was probably more of what they're seeing. Even affordable markets like San Antonio are seeing $320,000 median home prices, and which are pricing out a lot of your locals. And that's the other thing that you see is that uh, real estate is so local to your area. Being in the Washington D.C., Northern Virginia corridor around Maryland, what our home prices are in this area compared to a San Antonio, that's a big difference. Here, a $320,000 house in that DC metro area, that's typically sometimes what the cost of just the dirt is. Um, it, you know, $320,000 home in and around the DC area, it's going to need probably 320 to $500,000 worth of work in it to bring it up. Probably at least $150,000 worth of work just to get it to be livable. Um, Buyers today are they're anxious. They know interest rates are you know making affordability difficult. Many believe a crash is coming. So now the expectation, getting back to that expectation part of it, is that you have buyers now um, expecting an event to happen. A lot of times when this happens, is that uh, it becomes a self-fulfilling prophecy. So if the sentiment with buyers is that there's a crash or something like that coming, sometimes it manifests into a crash itself. So, but in the meantime, what we're having is inventory building and things are just not moving like they are. Um, I have a lot of friends that are real estate agents, and I've asked them what the market looks like. A lot of them are telling me that they've had, a lot of people that have been looking over the years. They have a big inventory of buyers. It just comes down to whether that house is priced correctly. If it's priced correctly, it sells. Um, if it's not, it sits. When the house sits, it becomes stale. When it becomes stale, buyers are asking, what's wrong with it? Is there something wrong with it? Um, there's more concessions going on that houses, even though they're priced appropriately, where the something comes up in the home inspection process where sellers are giving more concessions to the buyers than they ever did before. There was a period, probably 18 months, 2 years ago, where people were waiving the right for home inspection. That backfired on a lot of people. I do not recommend that. There is not a single house that I can go in and not find something. I can find something wrong with a house, just any house. I will find something if I spend enough time. I believe you, I will find something. Um, Sellers are hopeful, and the biggest thing is they're in denial. They're in denial that the market has changed. They don't want to necessarily listen to a real estate or someone who's a professional that's told them that it's changed, because their expectation is they want the most amount of money that they can get for the property. So it's more of what's happening is it's a psychological tug of war that's happening. Um, when sellers finally get to the port where they capitulate, and this is where you'll see sharp prices drop, you'll see overbuilding, and you'll see overhyped markets. Um, when that capitulation happens, uh, that's when you know that when nobody wants to buy a house and when nobody wants real estate, that's those are signals that tell you it's probably the time to look at it. That's always been a good indicator for me when somebody doesn't want something. Um, why don't they want it? One, you always want to go to what's wrong with it, or you say to yourself, can they not afford it? Can what is the reasoning behind it? Um, let's look at. I'm just reading over some notes that I have here. I'm trying to be better with this. Young families trying to buy and are priced out of both home ownership and rent. So, y- there is a possibility you may see rent decrease because there was an overbuilding of multifamily housing. But as more and more people sell homes or lose homes, you're going to see that inventory get absorbed. I work on as a consulting in the multifamily housing. So I'm seeing projects that are finished up or have been finished, and those builders not they're not actually putting new projects online yet. Um, they're looking at what those occupancy rates have been doing. So an occupancy rate when you have like an apartment building, multifamily, they want it. Believe they got to have if it's a newer property, they got to have very high occupancy rates in order to cover their costs and to make money. You're starting to see a lot of these multifamily housing projects that went in where even at a high 80, low 90% um, occupancy rate, they can't cover uh, the expenses on it. So you're starting to see in areas, Nevada's one where these multifamily projects were built. They may have been valued at, let's say, 140 million, and they can't make money on them, so they're dumping them. So how much are they dumping them for? Significantly less than that. I've seen as much as a half or 60% less. So that means now that $140 million complex is selling for 40, $50 million. Now, it's still a lot of money, but you look at the asset now, someone had to lose that. Was it the builder? Was it the bank? Who was it that lost that? Somebody lost that money. A lot of projects aren't coming online because they can't make it cash flow. And these projects have to be able to be cash flow. And the reason they don't cash flow is because we had that big boom of multifamily houses and all those units hit at one time. So it's always a boom bust in that cycle. There's never a steady trickle into the market because a lot of times you go into an area and you build, it takes you sometimes 5, 6, 7 years to plan out to build one of these. You got so much money and invest it. It's a gamble on what the market looks like when you actually go to rent it. Um, so that is a big gambling part of when you're building. And then a lot of times it's very hard to stop that machine once it gets going. And then once it gets started, the time in which to build these projects are usually a year, 18 months of actually construction time to build it. The market can change in that time. So you could be going into building something and the economy looks pretty good. By the time you actually got permits, started construction, the market could be in a complete free fall in recession. So, that's something that's happening. Um, you know, local governments, you look at this whole thing, we're in a situation where local governments are about to lose a lot of tax revenue. And um, how are they going to lose tax revenue? Well, one of the things that I've been looking at are liens, tax liens. So tax liens are a thing where you can, uh, a municipality will put out where someone didn't pay their property taxes, and they'll put it out. That municipality, they don't want to own that house. Um, the mortgage could be paid on it, but they didn't pay their taxes. So they lien the property. Um, when they lien the property, they want their money. So on a tax lien, anybody can come in and pay that lien off for that property. Now, that lien doesn't just go away, it gets recorded that someone else paid for that lien. And now they become the first person in line to recoup that money. Now, typically, you got to go through the legal system in order to do it. Some municipalities help you get through that, some don't. But usually, when someone's not paying their taxes, means they're not paying their mortgages. But that's a whole nother world of looking at things through tax liens. Um, so not only do local governments lose, uh, furniture stores, landscapers, title companies, appraisers, everybody feels a slowdown. Um, Construction jobs, we're seeing that. REITs and real estate stocks are starting to show cracks. Now you say, why are REITs? If you don't know what a REIT is, it's a real estate investment trust. REITs feel the pinch because of redemptions, um, pension plans, different things like that. People that have retired, they have to redeem when people are going to sell their stocks. Um, a lot of times, what happens is to meet these redemptions, uh, they get to a point where they have to raise capital. In order to raise capital, sometimes they have to sell units in order to do that. Uh, this market, the real estate or the investment climate right now is at times on shaky ground. People, when they need money, they're looking for redemptions. And so these REITs can be, depending on what sector they're in, can be in a tough spot when it comes to that. Whenever REITs have to sell properties in order to raise money for the redemptions of their stock, lot of times it's not because it's really good times. So they're not selling it at high prices. Again, I already went over this with uh, housing isn't just shelter, it's a financial engine. And when it stalls, everything else slows with it 100%. So I went over the builders side of it. Cash heavy buyers are waiting for that capitulation. Um, Syndicators are panicked as short term rental cash flow dries up. Yep. Long term buy and hold investors, they're waiting for this opportunity window to show its head. Um, so, what do you want to watch out for? Keep an eye out on Fed rate changes. Now, the Fed doesn't control interest rates on homes. That is a fallacy. Um, your interest rates on your mortgages are based off typically your 10-year bond. Um, so, what sets the 10-year bond? Well, a lot of times, what sets that is how the auctions are going off, and the faith in the issuing agency, which happens to be the federal government, which just got downgraded. Um, so the reason it goes off of a 10-year treasury versus a 30-year treasury is because most people don't even keep their mortgages 10 years. So it kind of goes off of that. So if a 10-year treasury note is trading for 5% or whatever, a mortgage company comes in and they add their percentage to it or points to it. There's 100 points in one percentage point. So let's say they add 200 points, so that would be 2%. So now that 5% uh, 10-year treasury that they're basing it off is they're basing it now off of 7%. Um, and they make what's called the spread, the difference on what they got the money for and what they're loaning the money out for. And they're making the spread on that. Some is higher, it's 2.5. That is all based upon how your credit score is. The less of a credit risk you are, the better interest rates you're going to get because the lending institution feels as though that's they don't have to worry about you paying. You you roll this all into with student loans, and especially if you're a young person and your student loan you haven't paid, you just got whacked 100 to 200, 250 points on your credit score. You're no longer getting um, a prime rate on your uh, for to borrow any kind of money. Um, are they going to add 300 basis points or 3% or 4% return? So does that mean is that mortgage payment for someone to have student loans that hasn't paid, is that going to be 8 or 9%? Or are they even going to give you the money at all? Uh, that puts a lot of people, buyers, in a precarious situation because the previous administration was preaching that you didn't have to pay those back, or they were going to work out something that never came to fruition. So a lot of people bought cars or boats or different things that had student loans. They didn't pay their student loans. Now all of a sudden, they're going to use wage garnishments against those people that haven't paid. So you can see where this is all swirling around. There is a storm coming. There's clouds. I mean, it's all in front of us that there's something amiss and there's something really coming. Um, so buyers don't get pre-approved. Target buyers. If you're looking to buy something that's coming, um, get pre-approved. Target stale listings. Negotiate aggressively. Ask for everything. Um, Sellers, price it right. Offer flexible terms, and if you can, just wait it out. Um, Also, stack cash. Um, Watch for I'm saying third to fourth quarter distress. I feel that something's going to break when you hear people like Jamie Dimon and others talk about a black swan or something brewing, where it could send a hard ripple effect through it. I don't know if that's code for banking issues or whatever. There's something coming that's going to really, I think, create an opportunity if you're on the right side. If you're not if you're not on the right side, it could be it could be disastrous. Again, focus on cash flow. Bottom line, we are witnessing a freeze in the American housing market, and it's going to reshape real estate for years to come. Stale inventory is growing, the power is shifting. I hope you get something out of this. Stay sharp, stay informed, hit that like button, subscribe. Um, be ready when opportunity knocks, whenever that might be. Uh, Thank you for your time, and I'll catch you on that next one.